Millions of investors buy exchange-traded funds thinking they are safe, diversified, and low cost. But some of the most popular funds are quietly destroying wealth through hidden fees, dangerous leverage, and misleading names. In 10th place, SQQQ markets itself as a powerful way to profit when the NASDAQ 100 falls, promising 3 times the daily inverse return. But the reality is a structural trap built into the fund's daily reset. SQQQ rebalances to minus 3 times the NASDAQ 100 every single day, which means compounding and volatility drag will erode its value rapidly if held longer than a trading session. The prospectus is blunt. The fund may lose money even if the NASDAQ 100 index does not change, rises, or falls only modestly because of daily rebalancing and compounding effects. Over a typical year, a buy-and-hold investor in SQQQ has lost about 38% of their money, even if the index itself barely moves. The 0.95% annual expense ratio only adds to the damage. The ETF wrapper may look familiar, but here, structure is destiny. With SQQQ, time is your enemy, and the losses are built in from day one. Number 9. ARKK trades on a promise of innovation, but under the surface it is a concentrated high-turnover bet on a handful of volatile growth stocks. Despite the marketing around disruptive technology, the fund routinely places about 30 to 40% of its assets in just 5 names. That level of concentration means a single stock blow-up can devastate returns, erasing any illusion of broad diversification. Its expense ratio stands at 0.75%, a steep premium compared to plain index funds charging a fraction of that amount. Active trading jacks up hidden fees, and the fund's performance swings wildly with the technology cycle, leaving long-term investors exposed to single-stock risk and fee drag masquerading as a sophisticated strategy. 8th place, JETS wraps itself in the language of smart beta and global diversification, but the reality is a narrow bet on just 4 U.S. airlines, American, Delta, United, and Southwest, making up about half the fund's assets. The expense ratio sits at 0.6%, 6 times higher than a plain S&P 500 exchange-traded fund, quietly draining returns even before the sector's notorious volatility takes its toll. JETS is trademarked as U.S. Global Jets, and in 2022, the fund's sponsor paid finance influencers to promote the exchange-traded fund in sponsored YouTube videos, pushing the narrative of a post-pandemic airline rebound. Clever branding and influencer hype cannot change decades of poor sector performance or the risks of betting on a single industry. If you've made it this far and this is opening your eyes, hit subscribe. New videos exposing misleading financial products every week. For retail investors, a catchy ticker and sponsored optimism are no substitute for real diversification. Number 7. Boyle promises double the daily move of natural gas prices, but behind the aggressive branding lies a recipe for rapid wealth destruction. The fund resets its 2 times leverage every day, compounding losses in volatile or sideways markets. The real danger comes from its structure. Boyle holds front-month natural gas futures, which are almost always in contango. That means each month the fund is forced to sell lower-priced contracts and buy more expensive ones, locking in a loss known as roll cost. Over time, this dual decay leverage drag plus futures roll devours capital at an alarming rate. From its 2021 peak to its 2023 low, Boyle plunged 67% even as natural gas prices oscillated. The annual expense ratio sits at 0.95%, quietly draining more from any remaining capital. For long-term holders, Boyle is less a bet on energy and more a slow-motion siphon on their investment. Number 6. NUSI tempts investors with the promise of steady high income, boasting a 7 to 8% yield. But the real story is buried in the fine print. NUSI's payouts are largely financed by returning your own money, not by generating organic income. The fund runs a so-called collar strategy, holding the full NASDAQ 100 while selling call options about 35% out of the money and buying puts roughly 20% below the market. On paper, this creates a stream of option premiums, but the prospectus is explicit. Distributions often consist of return of capital. That means as much as a quarter of the advertised yield is simply your investment being handed back to you, slowly eroding the net asset value over time. The 0.68% annual fee adds another layer of drag, and the collar caps upside during bull markets. For investors chasing yield, NUSI's income illusion can quietly drain wealth. It is proof that a high payout does not always mean real earnings. Number 5. Corn is marketed as a simple physical way to ride the price of corn. No futures account, no K1 tax form, just pure commodity exposure, the pitch goes. But the reality is far from straightforward. Corn holds only futures contracts, not actual corn. The fund's prospectus spells out a strict rule: no more than 25% of assets in any single contract month. This forces constant rolling between futures, exposing investors to seasonal contango where new contracts cost more than expiring ones. Over time, this roll drag quietly siphons returns, leaving the fund trailing spot corn prices, especially in years when the futures curve is steep. The expense ratio sits at 0.7%, high for a passive product that does not even own the commodity it tracks. The no K1 pitch may sound reassuring, but the real cost comes from structural decay, not paperwork. For investors lured by the promise of physical exposure, corn's mechanics are a costly surprise. Number 4. UVXY promises to amplify volatility, but what it really delivers is relentless wealth destruction for anyone who holds it more than a few days. This fund targets 1.5 times the daily return of VIX short-term futures, a market notorious for steep contango where each monthly roll means selling low and buying high, locking in a loss before fees are even considered. The UVXY prospectus spells it out. Roll cost is a built-in drag and the daily leverage compounds the damage. The results are staggering. Over 90% of value has been lost by long-term holders, with a 94% drawdown from recent peaks. Since 2011, UVXY has undergone multiple reverse splits just to keep its share price above water. Each one is a reset that masks catastrophic decay but never restores what has been lost. The 0.95% annual fee only accelerates the erosion. For retail investors, UVXY is less a hedge and more a slow-motion wealth incinerator. Coming to the top 3, DBMF positions itself as a sophisticated gateway to hedge fund-style managed futures, but the reality is a black box that quietly siphons away returns. The fund's pitch is simple: replicate the performance of elite commodity trading advisors (CTAs) using proprietary models. Yet investors pay a steep price, an annual fee of 0.85%, nearly 3 times higher than some plain vanilla CTA index ETFs. Over the 4 years from 2020 to 2024, DBMF delivered a cumulative return of just 12%, while the Bloomberg CTA index, accessible through cheaper alternatives, returned 18% in the same period. That 6% gap is not just an unlucky streak, it is the direct result of FE drag and opaque, model-driven allocations that are not disclosed to investors. While the marketing leans on the allure of institutional strategies, the numbers show that a simple basket of futures or a lower-cost CTA ETF would have outperformed without the premium. For retail investors, DBMF is a costly lesson in paying up for complexity that does not deliver. In second place, GLD and IAU both promise simple physical gold exposure, yet there is a costly difference hiding in plain sight. GLD charges 0.4% annual fee, while IAU's expense ratio sits at just 0.25%. That gap might sound trivial, but over 20 years, a $50,000 investment bleeds away $4,000 in fees with GLD versus $2,500 with IAU. The twist is that GLD still holds nearly 6 times the assets of IAU. Why? Liquidity and brand. GLD's bid-ask spread averages 0.89 basis points compared to IAU's 8.75 basis points, making it the darling of institutional mandates and big traders. This liquidity premium locks in a cycle. More assets mean tighter spreads, which attract more flow, regardless of higher fees. For retail investors, the result is paying up for a ticker symbol and a tiny trading advantage that rarely matters on small trades. The lesson is clear. Even without leverage or exotic derivatives, a familiar ETF wrapper can quietly drain wealth through nothing more than a brand premium. And finally, in first place, XIV stands as the cautionary tale that every retail investor should know by heart. Marketed as a way to profit from falling volatility, XYV was an exchange-traded note tied to the inverse of the VIX, promising double the daily drop when markets calmed. But hidden in its prospectus was a single clause with catastrophic power. If the VIX spiked more than 80% in a day, the issuer could terminate the product and pay out whatever was left. On February 5, 2018, that exact scenario unfolded. The VIX exploded and XYV collapsed from $58 to $2.30 overnight, a 96% wipeout not from a market crash but from the product's own design. Credit Suisse, the issuer, triggered the acceleration clause, leaving investors with almost nothing. Online forums filled with stories of five-figure losses, retirement dreams shattered in a single evening. The annual fee of 0.7% was trivial compared to the structural risk built into the contract. XYV was not just a bad trade, it was a financial time bomb detonated by a prospectus few ever read. For anyone who believes an ETF or ETN label guarantees safety, XIV's demise is the ultimate warning. Sometimes the biggest risk is not the market but the product itself. Across all 10 funds, one reality stands out. Complexity and clever branding routinely mask structural hazards that erode wealth, regardless of market direction. The ETF label no longer guarantees transparency or efficiency. In today's market, trusting the packaging over the product costs real investors real money. Stay vigilant.